Gold prices climbed to $1,700 level earlier today, with the pressure extending a short-term rally after bond yields reached a sharp fall and the easing of the dollar from its new 20-year highs. Furthermore, the scheduled speeches by various Fed officials at a first glance appear insufficient at boosting the dollar higher, despite their hawkish tone, and the market currently awaits patiently for the employment data due Friday. In this report, we aim to shed light on the catalyst driving the precious metals price, assess its future outlook, and conclude with a technical analysis. The greenback retracted further from its highs yesterday after the softer-than-expected ISM manufacturing PMI results heightened the fears that the US manufacturing complex recent slump has fallen victim to the Fed's aggressive intents, thus posing the question as to whether the Fed will take its foot off the pedal. The unexpected markdown of the key metric pointed to a slowdown of the US factory growth, knocking the dollar back from its 20-year highs. Not only that, but the recent sharp fall of the US 10-year Treasury yield from its highs also weighed on the dollar and gave room for the pressures to rally after a period of sustained devaluation. The fall could indicate the investors' doubt that the central bank will be able to continue to tighten the monetary policy aggressively, since there are signs that economic activity is slowing down. Another factor contributing to the cool of the greenback was the resurgence of the sterling from its all-time lows after a tumultuous last week, where we saw the market's negative reaction to the UK announcement of the mini-budget, the Bank of England's liquidity operation announcement amidst a tightening cycle, seeking to purchase long-dated gilt bonds in an attempt to safeguard the anemic pound, and yesterday's U-turn from the UK government maintaining its top income tax rate after public backlash. All things considered, the dollar sustained its role as the go-to safe haven asset for the time being, and gold's run may be short-lived in our assessment. The next catalyst that may indirectly influence the value of the bullion is the employment report expected to hit the markets this Friday, which be of interest for the Fed since it falls under its scope for maintaining tightness in the US labor market. Nonetheless, we also feel the urge to note today's scheduled speeches of Dallas Fed President Logan, Cleveland Fed President Messer, San Francisco Fed President Daly, and Atlanta Fed President Bostic, all of which will be monitored for any deviation from the main narrative. Should the speeches continue to deliver the as-expected hawkish undertone, we would expect seeing support for the dollar and gold to remain prone for downside due to their inherent negative correlation. Thank you for watching.